So this is the RV park underwriting model that I created to help other RV park investors and people who might be interested in getting into RV park investing to really strip everything down to the core levers that really move these deals. And I built this, like I said, as an RV park owner investor myself, and I've done about 15 years of commercial real estate analysis, cash flow modeling, financing, brokerage for a variety of commercial real estate assets. And so I built this to help other investors get into the RV park business. So this is the website where you can go to get the model. You can see there's a little promo code there for the launch. Chances are you're probably seeing this video well after that. But there's also a promo code in the description. This is where you can get the free preview of the model. This is a view-only version of the model that just you can kind of pluck around in here and see how it all is laid out. But I'm pretty much showing you that right here. But of course, if you want that, you can fill out your email address here and I'll send that to you. Not a subscription, not a course. This is just a one-time purchase for a product that you can use forever. That was very important to me to have something that you can just use. And this is the sample of the underwriting guide that goes with the model. And it's just kind of a handy guidebook that goes over the definitions of what these inputs are, how they impact the model, and then there's some tips in there that are practical tips that I've learned as an operator and investor in these properties. So then next on the website, you'll get to the FAQ. This will go over probably a bunch of questions you might have. Yes, this is designed for beginners or people with intermediate level Excel skills. It's just straight inputs and then you can interpret the outputs. But if you're advanced in your Excel knowledge, it'll be handy too, especially if you're someone who does analysis of a bunch of different acquisition opportunities every day. And of course, one of these questions is about if you buy a version, what happens if there's a new one? And if, as long as it's within the same version, 1.2, 1.3, then, I'm happy to upgrade you for free on any of those if you fill out the form online. So let's dive into the model. The first inputs you'll find in the top left section here are your property name and address. These are just informational for your executive summary. Then the acquisition date is your first input that actually influences the model itself. It populates here, and then you'll see that there's an end of month convention for how your IRR is calculated. And then the acquisition NOI, which directly impacts your acquisition price. You'll see that between that and the acquisition cap rate, those work together to give you your acquisition price, which of course you can back into any price that you want to see. But I notice I typically am changing one or the other when I'm doing my acquisitions. We'll keep it at 1.5 million for simplicity. Then your closing costs, which are just a percentage of your acquisition price that are deducted. And then this is your first real input that is different for RV parks as opposed to other properties. It's your seasonality input. So I just put in 9 months here to show that we're open 75% of the year. Obviously makes a huge difference on the investment performance to close for 3 months out of the year. So I'm going to put that back to 12 months. Next up is the acquisition financing section, which you can change the loan to value, the interest rate, and what I'm going to do next is change the term of the loan. I'm going to change it from 120 months to 60 months. And you'll notice what happens with the investment performance there. Nothing changed because the hold period is 60 months down here. So there's no impact because the loan expires at the same time as the sale of the property occurs. I've also got interest only, which is I've adjusted to 12 months here. What that does, of course, is It eliminates your principal payments, so you're just paying interest for whatever time period you select there, which you'll notice that on the investment performance side, the longer the hold period, the lower your IRR and the higher your equity multiple, generally speaking. So we'll go to 10 years here, and you'll see the equity multiple went all the way up to 4, and then levered IRR decreased. So you get more money at the end, but it's not as great of a rate of return the longer you go out. Pretty typical, but those can change depending on how you stress your inputs. Then you've got your disposition or your sale cap rate and your closing costs at the time of sale, which is reduced on the back end. So now let's dive into the rental income side of things, which is really what's going to drive whether or not this is a good investment. So I've got 60 RV sites here, an average rate, which you'll just need to determine what is your average rate for the month. And I've got 600 here, but let's say I feel like the property is going to do better after I make some operational improvements, then I can change that to, $650 or whatever I think that it's going to be. And then occupancy, I think, let's see, 65% is probably realistic at this time in the market, but you'll see the net operating income in year one there is 180 something thousand, and acquisition NOI is 135,000. That's your going in. So I'm saying in year one it's gonna do that much better. So I'm gonna kind of adjust this here to make it a more realistic picture for the year one net operating income that you can see there in the key performance indicators section. And so that gets you to your monthly gross income for the rental income side. Next is your other income, which I've got utility reimbursements, and that can include electric, water, sewer, internet, whatever you deem it to be. Maybe it's just electric, but you just input whatever you expect your average monthly utility reimbursement to be, laundry and vending, store sales, propane. Let's assume that this place has propane, so we'll add $1,000 there. And those two numbers combine to get you your monthly potential gross income. Now, vacancy and credit loss are deducted from those numbers directly. And so are discounts and promotions, seasonality, which we've gone over earlier. And I'm going to go ahead and change that to 1%. 2% seems like kind of a lot. And then you've got your growth rate assumptions, which these apply to each clearly marked section. So rental income applies to the top section, and then other income inflation. And again, since I'm assuming that I'm improving this park after buying it, I'm going to assume that those inflation numbers are higher than the general expense inflation number, which is 3%. And operating expenses are calculated here as a percentage of your effective gross income. Effective gross income is your potential gross income from combining the first two sections and less your vacancy and discounts. And I'm going to just change a few of these. Maybe repair and maintenance is a little higher than I thought. And that number at the bottom is your operating expense ratio, which if you haven't encountered that before, you will, whether you're buying, selling, talking to a bank, whatever. So at the top right here in your key performance indicators, you got your potential gross income, which again is just the combination of those two sections annualized. Your effective gross income, which is once you deduct these here, and seasonality, I'll show you again. Let's go to 10 months. It would reduce PGI by that percentage. And then that gets you to your net operating income for year one. And that's year one after you've purchased the property. So we've got 171,000 NOI of year one against going in of 135,000. So we're doing some big improvements here, which is your capital expenditures. So here we're assuming we're doing $75,000 worth of renovations in month 3. Don't know what those renovations are, but we're doing them. And then let's add a Wi-Fi upgrade. and we'll call it $15,000 worth of Wi-Fi upgrade, and we can put that expense in any month during the hold period. We'll do it in month 6, and here you can do capex inflation as well. So if you've got it going outside of year 1, then that expense will escalate. So see, we put it in month 15, and that didn't really change anything. So let's call it 50,000. So you'll see that moved the needle on the investment performance. And as you go further along, those growth rates really impact the later cash years quite a bit. We'll bring that back down to 0. So that's just assuming it's going to be $50,000 in month 15. And then we have our capex reserves, asset management fee, which you can do as part of a percentage of your equity invested, effective gross income, or net operating income, which I've never seen it done off net operating income, but I know some people have done deals like that. So that's included in there as well. This is the executive summary, which really just highlights some of the sections, especially the key performance indicators, the KPIs, and then you've got your cap rate sensitivity table here, which that 9.5% comes from your input on the inputs tab, 9.5% disposition cap rate. We'll change it to 975 so you can see it. So it changes there. And this drop-down menu for presentation purposes shows you a matrix of different cap rate increments. What would the sales price be if cap rates move 50% higher or lower? And then this is your monthly cash flows. Pretty straightforward. And then down at the bottom, you'll see the growth rate factors as well. These are just annualized. So your first year, you won't see any growth rate, and then it kicks in month 13. Annual cash flows, which I'll show you here. Say we're not doing a full 10-year, we just want to see 5 years worth of cash flows, then boom, there you go. Nice and easy. Then we'll go to the loan repayment schedule, which, remember, we did 12 months of interest only, so the principal is zeroed out there. It's not impacting your paid-in equity, which reduces your monthly payment. And that pretty much wraps it up. So like I said, you can get the model here at rvparkanalysis.com. There's a couple of buttons on here to purchase it. That's certainly the best way to show that this was helpful to you, or maybe it's just fun. Maybe you just like doing this stuff. I do. And, you can always get the free one just to kind of look at and admire. But if you want to start underwriting some deals, start making some offers, go ahead and purchase it with the YouTube promo code here in the description.